A lot of mid-cap IT companies to deal with, and one such company is Zensar. They've managed to beat the expectations when it comes to top line and very resilient margin picture. So let's welcome on board Manish Tandon, the MD and CEO of the company, to talk to us about how much of this is actually sustainable. Manish, hi, good to speak with you. Thanks for making time for ET Now. To begin with, let's discuss your margin performance itself. You've managed to maintain it almost at 15.7% despite the wage hike. I do understand that there was a one-off element here, but barring that, how was the performance on operational front? And more importantly, is this kind of performance sustainable?
Yeah, I think on margins, while people like to talk about margins and revenues differently, I like to talk about overall margin growth for the company. And I'm very pleased to report to the investors that in the first half of this year, we have made more profit than what we had done for the entire full year of FY23. As to margin sustainability and the performance, our performance was pretty good considering the market situation that we have, where anything with a plus sign is good, and we grew 0.6% in revenue terms. But we grew tremendously both in earnings per share and in the profit after tax. So, a very good performance overall. From a business perspective, I can tell you that except for the high tech as a vertical, we are seeing all round growth. And if high tech as a vertical had been even flat, then we would have seen a 3.5 to 4% sequential growth even in our top line. So overall, I'm very satisfied with the performance. Also, I believe that our margin guidance has been EBITDA margins in the mid-teens. We are doing much better than that. So that gives us some headroom to invest in our business for revenue generation and invest in our clients.
Right, Mr. Tandon, this is Vinny joining in the conversation as well. Right, we're talking about your EBITDA margins, the mid-teen levels is what you're talking about as well. But, as of now, that is at 14 to 16% range is what is there. So is that sustainable going forward? And also, some of the analysts actually believe that your margins may have peaked. So what is your view on that? Do you concur with that? And maybe this is the level that will go on and we'll see that at this 14 to 16% range.
No, I think, as I said, our stated goal is to have an EBITDA margin in the 14 to 16% range. Currently, we are at 18.6%. And as I continue to maintain, there is a trade-off between margins and revenue growth. In fact, I look at the overall performance of the company as a sum of margin percentage and revenue growth percentage. So what it means is that if I invest more in my business, that will lead to a higher revenue growth, but may lead to a lower margin, and vice versa also. So for me, it is all about optimizing the net profit or the earnings per share. And that is what we are focused on instead of looking at just revenue growth or just margin percentage.
Focusing on profitable growth and EPS remains that important factor. But you talked about how the headwinds in the high-tech vertical is what impaired your performance when it comes to the revenue growth as well. Talk to me about how the second half of the year is looking like, especially Q3 on account of seasonality and furloughs is usually a weak quarter. Are you expecting weakness to be more than the historic average that we have seen? What's your take on how Q3, Q4 are likely to pan out?
Well, if you noticed, we had strong performance on the order bookings. Last quarter, we booked orders worth 195 million or so, which was about 30% higher than last quarter. So that is a positive sign, but the seasonality of the industry has not gone away. So we expect that, like in the past, whatever has been the impact of the furloughs and the lower number of working days and shutdowns, etc., will happen this year also. If we can sustain our pipeline and our order bookings, then obviously Q4 should look better.
That's the big question. Is that $195 million kind of deal win sustainable then?
I hope so. I think we are seeing a good pipeline. Overall, our pipeline has, I mean, you start at the top of the funnel and order booking is the bottom of the funnel, right? So to say that whether the order bookings are sustainable or not, you have to look at your pipeline. And I can tell you that our pipeline is also up, even as we speak. So I'm hopeful that that we'll continue to perform well on order bookings.
What I also want to understand is in terms of, is there any delay in execution that you're seeing? Especially because, I'm asking this because your revenue growth is lagging your peers. So is that one of the concerns in terms of execution?
No, there is no execution issue that I see. It is first of all, I don't think at least in the last 3 quarters since I have been there, our revenue growth has been lagging. Overall, we have grown sequentially in revenues uh, by 2%, 2%, and 0.6%. So it is not that the revenue growth is lagging. But again, the market has been tough. Those who had the momentum going in to this financial year have shown better revenue growth. When I came in, I had actually no momentum. It was actually I inherited a quarter after which where the decline was close to 6-7%. So from that perspective, I think we are doing pretty well.
No, you have arrested the decline, and of course, the street has given a thumbs up to that. That's quite evident, Manish, in the stock price, which is up 160% on a YTD basis. That at a time when rest of the IT companies have been very sluggish. But talk to me about that. Then, what is the focus area? We have managed to arrest the decline right now, stabilize it at 0.2%. When do you see that recovery and growth coming back? Is it likely to happen in the next couple of quarters, or given the environment, you are hopeful of that only in FY25?
See, Q3 next quarter is a very, very tough quarter for everyone. And it's going to be, I mean, it will follow the historical trends that we have seen. Q4, if we execute well on our pipeline, then Q4 should look better. But I think we will finally see very, very good, much better momentum. I wouldn't say very good or bad, but much better momentum in Q1 of next year rather than in H2 of this one.
Okay. The other thing I wanted to check with you was also on the pricing front because, when we were speaking to your rest of the peers as well, they did allude to the fact that, the competition is, of course, heating up, but it hasn't become irrational. What's been your take? Are you seeing any pressure right now in terms of renegotiations with clients or price cuts or even any deal cancellations or any discussion of any, deals being put on hold with clients as such?
No, I don't. I see delayed decision making. I see, that renewals, people, even for renewals, clients are taking a longer time to arrive at the decision. But I am not seeing um, stoppages and so on because clients do not want to spend money. Also on rates, we are not seeing on rates, thanks to inflation, we are not seeing a major push on rate reduction because I think our clients also are going through this cycle. And but they are definitely looking at cost reductions, which is basically trying to move more work offshore, offsite, etc. So because of the inflationary environment, the cost reduction has not really led to rate reductions per se, as such, at least for us.
Right, Mr. Tandon, thank you so much for joining in with us this afternoon on ET Now, giving us an understanding of what we should be expecting from the company going forward in the second half of the year, or how we should be expecting for Zensar Tech. That was Manish Tandon, MD and CEO at Zensar Tech, talking about overall their performance and looking to maintain their margins at mid-teen levels. Profits already much better in the first half of the year than FY23 combined. So keep an eye out on that. Zensar Tech on this year basis, 150% approximately return is what we have seen. But on that note, viewers, we're going to slip into a very short break. Don't go anywhere. We'll be back with more updates on the market after this break.